Loudly. Okay, so we're going to start chapter 8. And 8 is the end of our accounting cycle. In chapter 8, we're going to do something with those adjusting entries. If you remember when we did our adjusting entries in our adjustments in chapter 6, right now they're just sitting in the worksheet. Okay? They haven't been journalized and they haven't been posted to our general ledger. So therefore, the actual accounts in our general ledger are not up to date. So we're going to learn about getting the accounts in our general ledger up to date. And then we're going to learn about what closing entries are and why we need them. Okay. Is it changing on here? Yeah. Okay. So these are all of our goals. We're going to use the accounting terms for adjusting and closing entries. We're going to identify accounting practices related to adjusting and closing entries. We're going to understand the difference between temporary and permanent accounts, which is very, very important. Record adjusting and closing entries, and then prepare what we call the post-closing trial balance, which really just focuses on all permanent accounts. And then, again, fully close out the accounting cycle. Okay, so first of all, adjusting entries are doing the journal entries for those adjustments that we did when we did the worksheet. We do the actual journal entries so that we can get the ledger balance up to date. Because right now, if you remember, how do we get those balances for our trial balance? Our trial balance in our worksheet comes from what? The general ledger. Very good. It comes from the general ledger. And we did those adjustments, but are those adjustments in our general ledger yet? No, because how do transactions get into the general ledger? We post from the journal to get them into the general ledger. So that's essentially what we have to do here. Now we have to take the adjustments that are on the worksheet, put them in a journal entry, and then post them to the general ledger to get our general ledger balances up to date. So the information, all the information is going to come from the worksheet. Just like with our income statement, our balance sheets, all the information came from the worksheet. Same for our adjusting entries. All the information comes from the worksheet. We're going to match the two letters now. So if you remember before when we did the worksheet, we had an A and an A. We had a debit for an A and a credit for an A debit for a B and a credit for a B. We're going to use those to make our adjustments. And so if we look at our, this is the snap sheet of our worksheet up here at the top. We see on line 5 we have our supplies and we have a credit for our supplies, and then we have down here our supplies expense and we have the debit. So that's going to make up the two entries for, or the two accounts for our entry for the adjustment for supplies. So we debit our supplies expense for $715 and we credit our supplies for that same $715. So we just, write, these are all the steps. Write the heading, write the date, write the title of the account, the debit, and then write the title of the account and the credit. Just like any other journal entry. Good? Okay, same thing here. We're doing the exact same thing with our prepaid insurance. So we have our prepaid insurance. We're going to write the date. These, by the way, when we do our journal for our the adjusting entries, we're going to put the title in our journal for the adjusting entries in our journal. Okay, and then both of our entries are going to be the end of that fiscal period, whatever that fiscal period is. If it's the month, if it's a quarter, if it's the year, we're going to put whatever that date is, and that's going to be the same because you're going to do your adjusting entries both on the same day. Okay, so now we're taking again our insurance expense and we're debiting it, and then our prepaid insurance and we're crediting it. Again, to show that we're reducing our prepaid insurance by that $100, and then our insurance expense, we're going to update it so we're matching our revenues and our expenses. Okay. So, At the end of the fiscal period, for both of them, yes. So now, the difference between permanent accounts and temporary accounts. Our permanent accounts are what we call our real accounts. They have continuous balances from period to period. So think about your cash in your bank account, you personally. Okay? You personally have a balance in your cash account. At the end of the year, does your balance in your cash account go away? Like on December 31st? No. No, heck no. You'd be really mad if it did, right? Okay? I mean, I know you're going to buy me a really nice Christmas present, but that doesn't mean you have to use all of your cash for it, okay? So your cash is going to be the same on December 31st as it will be on January 1st, correct? Okay? So that's a permanent account, okay? So permanent accounts are used to collect data or accumulate information from one period to the next. The ending balance for the one period is the beginning balance for the new period. So basically, our permanent accounts are any asset, liability, or capital account. Your owner's capital account. Those are your permanent accounts. So if I said, is sales a permanent account? No, because it's not an asset, it's not a liability, it's not the capital. Temporary accounts are what we call nominal accounts. The balances are isolated for a specific fiscal period. At the end of that fiscal period, the balance is transferred into the owner's capital account. So we accumulate that information for a fiscal period, one fiscal period only. And then the changes are reflected in the capital account for that single period. At the end of the fiscal period, balances in the temporary accounts are transferred into the capital account, and at the beginning of each fiscal period, your temporary accounts start with a balance of 0. So your temporary accounts are revenues, expenses, owner's drawing, and what we call the income summary. And we'll learn about the income summary in this chapter. So think about it this way. How many of you have a job? Okay, so most of you have a job. Okay, so when we're talking about you and your jobs, how much do we say that you're going to make? We say that you're going to make X amount of dollars for that year, right? So if you're making, say, I don't know, let's say you make $3,000 for this year. Okay, and you have a tax return. You're going to prepare your tax return. You're going to prepare your tax return only for the $3,000 that you earned this year, right? You're not going to include the $2,000 you made last year, are you? No. Why would you, right? You're only going to include that amount that you earned for this year. Okay? In January, what do you start out with in terms of your earnings? You're back to 0. Okay? Same thing for a business. Okay? All of their revenues and expenses at the beginning of the year start at a 0 balance. It's whatever they accumulate throughout the year is what their revenue and their sales, revenue and their expenses are for that year. Okay? At the end of that year, they roll whatever they earned or they lost into their owner's capital account. Okay? And then they wipe those clean and they start out the new year. So it's the same like you. All your money that you make during the year, you roll it into either you spent it and you have it in clothes or shoes or whatever, gas or whatever, food, okay? Those are your expenses. Whatever you have left over is accumulated in your cash account, in your bank, right? Well, it's the same thing for a business. Whatever they've got left over, they accumulate into their capital account, okay? So, closing entries are the journal entries that we use to close those temporary accounts and roll them into the owner's capital account. Temporary account balances must be reduced to 0 at the end of the year. This prepares those temporary accounts to be used in the new fiscal period. Otherwise, the new fiscal period would include information from previous fiscal years and it would be misstated. And we can't have it be misstated. Of course not. So the closing process allows the balances of the business's accounts to be transferred either into income or loss and then transferred into the owner's capital account. And then this then applies that matching of revenues and expenses, because we're going to isolate those temporary accounts to just that fiscal period that you're dealing with. Okay, and any temporary accounts are going to be closed at the end of the fiscal period. So our closing process just takes the amount that's in the temporary account and rolls the balance down to 0. You close it out by taking that balance, and if the balance is a credit balance, you're going to debit it to close it out. And then you roll that into this temporary account that we're going to talk about, income summary. So if revenue has a credit balance, which it's always going to because it's got a normal side balance of credit, then to close it out, we're going to debit our revenue for that $3,565. Whenever a temporary account is closed, the closing entry must have equal debits and credits, and you'll see that in a minute. So, little quiz. Identify your permanent or temporary accounts. So guys, take a minute and do that. All right, so first off, what do we have for cash? Permanent. Capital? Sales? Okay. Rent expense? Prepaid insurance? Good. Accounts receivable? Payable? Drawing? Equipment? And utilities expense? Temporary. Okay. Good. You guys did pretty well with that. Okay. So, what's our income summary account? It is also a temporary account. It is like the ultimate temporary account because it's used for one purpose only, to process through the closing entries. That's it, okay? It's the temporary account used to summarize the closing entries for revenues and expenses. So we basically close our revenues to income summary and we close our expenses to income summary, and then we take the balance of the income summary and we close it to the capital account. It's a little in-between step. It is a unique account in that the income summary has no normal side balance. Okay? The balance in the income summary account, so you should write this down. The balance in the income summary account is dependent upon whether your business is going to show a loss or a profit. The balance in your income summary account is dependent upon whether your business is going to show a loss or a profit. Okay? It's determined by the amounts posted to the account at the end of that fiscal period. So when you see this, we're going to do this. Income summary, if we're going to debit our total expenses to the income summary, and we're going to credit our revenues. If our debits are greater than our credits, okay, if our revenue are greater than our expenses, then we would have a net income. If our debit is greater than our credits, then we're going to have a net loss. Does that make sense? Think about that from when we just did our income statements and we did the worksheet. Okay, so if our revenues, which have a credit balance, are greater than our expenses, then we have a profit. Right? If our credits, which are revenues, are greater than our expenses, which are debits, we have a profit. If we have our debits, which are expenses, are greater than our revenues, which are credits, then we have a loss. Right? So that's what this is saying. Okay? So if you have a debit balance, then your revenues are less than your expenses and you're going to have a loss. So to do our closing entries, we have 4 things that we're going to do, and you have to do them in this order. So this order is very important. The way when you do your closing entries, your journal entries to close your accounts, you have to do them in this order. You have to close your income statement accounts first. Income statement with credit balances first. Income statement with debit balances second. Then the entry to record net income or loss. And then the entry to do the drawing. So it's revenues first, expenses second, income summary third, and drawing is fourth. You have to do your closing entries in that order. Good? So, let's look at this. Again, all of your information, again, you can write this, all your information all your closing and summary information comes from your worksheet. I can't write clearly. From worksheet. Okay? All of it. So where am I? I'm in my income statement columns of my worksheet. And I'm on the sales. Okay? And now my sales is a credit balance. So to do the journal entry, I don't know what was going on. My brain was getting faster than my mouth. Okay? I'm going to do a heading for my closing entries in my journal on my page. And do a heading for my journal entries called closing entries. And now my sales has a credit balance. So to close out my sales, my first entry, again, we're doing them all on the last day of the month, the last day of the fiscal period. Sales is going to be debited. Because why? I'm going to close it out. If I've got a credit balance, the only way I can close it out to zero is by debiting it by that same amount, correct? Okay, so then the offset to that, because we always have to have a debit with a credit, the offset is going to be to credit your income summary account. So we're going to credit our income summary account for that same amount. So these are just the steps. Write the heading, write the date, write the title of the account, and debit it. Write the title of the account and credit it. Second account entry is going to be to close out all of our expenses. This is another one of those compound entries. We're going to close out all of our expense accounts in one journal entry. So again, this blue part is our worksheet. Okay? So this is our worksheet right up here, our snapshot of our worksheet. Okay? And these are all of our expenses. They're all debit balances. So if we're going to close them out to zero, we're going to credit them, exactly, right. So we're going to do one compound entry. We always enter and when we're doing an entry, we always do our debits first. So we're going to debit to our income summary account for the total of all of our expenses. So we're going to take all of our expenses, our advertising, our insurance, miscellaneous, yada, 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 all the way down, and we're going to do credits for all of them. What's the total of that? We just add them all up, and then we're going to have the total of all of them that we're going to enter as the journal entry for our income summary. Okay, those are just all of our steps. Credit, yada, yada, debit amount, okay? So, what's next? In this particular case, we had a balance of revenues, $3,565. Balance of expenses, $1,466. Therefore, we know we have a net income. Again, if this is showing a net income of $2,099, that means our revenues exceeded our expenses. So technically speaking, we have a credit here. So in order to close that credit out, we have to do a debit to our income summary of $2,099. We're rolling that positive net income into our capital account. And it makes sense. Why does it make sense? How do we increase our capital account with a debit or credit? Credit. Normal side balance for our capital account is a credit, right? So right now, if you think about it, looking at these two accounts right up here, looking at these two accounts, what do we have? We have a credit balance, right? $3,565 is greater than $1,466 by $2,099. Okay? So we have a credit balance. So in order to close out that credit balance, we have to debit the income summary by that amount and roll that amount into our owner's capital account. Okay? As a credit. Because we're going to increase our owner's capital account. Okay? Last one is our drawing. Normal side balance for drawing is what? What's our normal side balance for debit, right? Okay, it's got a negative impact on our capital. So in order to close out a debit balance, we're going to have to do what to our owner's drawing account? Credit it, right. Which makes sense, again, because now what's the impact here on our capital account? We're debiting our capital account, which does what to our capital account? Decreases it, right. So, which makes sense. So we're going to debit our capital account for the amount of the drawing and close out our drawing by doing the $625 credit. Again, all the steps. So now if you were to look closely at all these adjusted, these are the postings to those accounts. If you look closely at them, you can see that, for instance, up here, well, cash is a permanent. These are all permanent accounts on this side. Where did my temporaries start? Okay, so my drawing account, if you look over here, in my drawing account, my capital account, where's my sales? There's the income summary account, my sales account. So if you look at how the ledger looks, look at how the ledger looks here. I wish I could make this bigger for you. I had my credit balance in my ledger of $3,565. When I post my debit, that brings my balance down to zero. So at the end, if you look at all of these temporary accounts, they're all brought down to zero. All of them are brought down to zero. Okay, because we're going to post that last closing entry on the opposite side. It brings them all down to zero. And then we go through the process of rolling them into the income summary. So here's where we roll them into that income summary. It's only used at the closings. That's it. So we first roll in our revenue with a credit. Then we roll in our expenses with a debit. And you can see right here where that balance is at $2,099 on the credit side. So we're going to close that out by debiting it. And then we take that debit and we bring it. Where's my capital account? There it is. We bring it up here, and we're going to credit over here the $2,099, and it increases our owner's capital account. Then the last one is that drawing, where we bring the drawing down here, close that out, and roll the reduction into the owner's capital account, and bring the owner's capital balance down. Okay? All right, I think that's the whole closing process right there. We're going to stop there.